Today I'm going to show you interviews by three interviews with money managers. One is they're all Canadian. The ones that are doing the interviewing: Jay Martin, James Connor, and David Lynn. From David Lynn and Jay Martin are from Vancouver. James Connor from Toronto, and they're interviewing two Europeans and one from the U.S. And so, interesting perspective on what's going on. They're all saying, in one form or another, they're all saying 2025, particularly January of 2025 or Q1 2025, is going to go into a down market. We have had an up market in 2023 and 2024, but they're saying 2025 is not going to be like that, and particularly January. And they make the case, they state why they believe that. So I think these are interesting because you're dealing with the interviewees are people like Felix Zelof, Daniel DiMartino Booth, and Henrik Zeberg. They're all extremely credible people that I pay attention to. I think you'll enjoy this because the theme is very similar. Their thesis is very similar. Hi, I'm Ben Reppond. Thank you for watching my YouTube channel and the broadcast today. Today is December 17th, 2024. We are closing in on the end of year. So I'm going to begin with this piece by David Lynn, and I put this on the title of the video, is that January will be hell for investors, especially buy and hold investors. This was the thesis of Felix Zelof, interviewed by David Lynn. And so I'll let you listen to that. He makes the case, Zelof makes a case for the market being extremely overvalued. And by the way, this is the same theme for all three people that I'm going to play for you. He does expect a down market particularly in the U.S., but worldwide in the first quarter of 2025. And for the year, it will be a roller coaster ride for investors, particularly buy and hold investors. And he points out it's a good market for those who are tactical, who are trader oriented. Roller coaster, he doesn't mean a roller coaster up, he means a roller coaster down. So that's an interesting view, and he makes a case for it. I don't disagree with him. So take a listen to Felix Zelof being interviewed by David Lynn.
Felix, always good to have you. Welcome back to the show. Good to see you.
My pleasure. Thank you very much, David, for inviting me.
One of your recent reports is called The Trump Bubble. Many themes covered in that report, and of course you write very frequently. We'll talk about that report and some recent news, but what is a Trump bubble for you?
Well, the Trump bubble is just Trump accelerated the uptrend and the euphoria in the marketplace. The bubble has been building for the last 2 years. It is driven by tremendous liquidity that the Fed injected via the back door. Via reverse repurchase agreements and things like that. And we are now at the level in terms of valuation that is the highest or second highest in the last 140 years. And when you get to those levels, as a long-term investor, when valuation is high, your future return is low, and vice versa. And bubbles, when you have parabolic markets, they do not correct by going sideways. So one extreme in one direction will eventually be corrected by going in the other direction and to another extreme again. So my point is that I would like to help people to get off the train before there is a train wreck.
American equities for 2025, is that still going to be the leader compared to European equities, Japanese, and perhaps Chinese?
I think it's the markets will swing together in sync. China will underperform, Europe will underperform, all the markets will underperform the US except when I'm right in the portfolio strategy. I expect a roller coaster year in the US. I expect the top very soon, early in Q1 of 25, and then a sell-off of maybe a little bit over 1,000 points in the S&P, or 15 to 20% in the major indices, triggered by uncertainty about the Trump trade policy, the tariffs, and perhaps also the Doji cuts that people are talking about. And that could lead to an important low sometimes in the second quarter, which I think will then be supported and helped by the Fed by easing, and then we go into another rally, most likely back to the highs or even a little bit higher than what we have seen, maybe to 7,000 or something like that on the S&P. And further out is unclear because it really depends on what sort of policies in detail are getting into place, because the policies that are being discussed in Washington are highly disruptive policies for the world economy, and that will have an importance for the U.S. economy as well.
Now, when I continue, the interview with David Land continues, and this is where where Zelof talks about the markets being overvalued and overheated. And my view of that is, for you as an investor, be careful right here. If you're tactical, this is probably going to play into your hand. If you're buy and hold, this may frustrate you. But his point is, my takeaway is, be careful right here as an investor.
There are a lot of open questions regarding all that, and as long as that is not clear, I remain on the cautious side because the markets are very overheated, very extended, and my technical tools are really sending warning flags, and that's why I'm expecting a medium-term correction. It could be, of course, worse than that, but I'm going for the medium-term correction for the time being, sometime starting probably in January.
The next interview I want to play is done by Jay Martin and with Danielle DiMartino Booth, and she makes the case for that the markets, and we know this, and the markets, the S&P and the NASDAQ in particular, are making all-time highs. Every day seems like another all-time high, and valuations are way overextended. And she goes, not only price to earnings, PE, but she says price to sales, 40% overvalued. Price to book, extremely overvalued. So when you see this, you know this when you look at the long-term picture of valuations and stock market up and downs, you know that when things get overheated, way overvalued, that what follows is a down market. Now, when I say that, I don't mean it's going to happen today or this week, maybe not even this month, but at some point not too far off, she makes the case for the fact that there is a correction in place. And it may be a little more than a correction. I don't think it's a crash, but if you said 15 to 25% down, that would be, in my opinion, more than a correction. I would just call it a down market. So I think 2025, based on what I'm hearing, I would expect a negative year for most investors. Now, if bond yields go up, and they have been going up, if bond yields go up and then bond prices come down at the same time that equity prices come down, and you may be thinking 2022, that's exactly what happened. Long-term government bond and the equity markets at one point during the year were down well over 20% each, and so bonds did nothing to protect investors. Matter of fact, in some cases, bonds were down more than equities. So it sounds like that could happen in 2025. We could be in for a very very difficult year for the buy and hold investor. At a minimum, if equities are down 15 to 25%, it's going to be very difficult for bonds to make up for that difference. So anyway, it's a good interview that he does. And of course, Daniel DiMartino Booth is a former member of the Dallas Fed and has written the book Fed Up. She's a little colorful personality, but she's very smart, and I think her insights have been correct as far as I can tell. So take a listen to this interview.
Let's begin just looking at the market. Love to get your thoughts on market climate right now. I'm going to attempt to paraphrase you from a recent interview that you did. Hopefully I get it relatively close. You were referencing some data that you recently read that said there's been about 1% of time in the entire existence of the U.S. stock exchange where equities have been this overvalued relative to their underlying assets. Did I capture that correctly? And if I did, would you mind expanding on that a little bit for me?
So that is correct. I mean, in the sense that that market strategists, and I wear another hat as an economist, we often look at the world in a bell curve. And once you're so far out in the tails of distribution and you're saying, geez, there's only one other time in the history of the financial markets, that 1% of other time in the history of the financial markets, it doesn't matter what you're talking about. You're talking about, in that particular reference, it's because the market is 40% more overvalued on a price to sales ratio than it was in 2000. But even on a price to book ratio, it's more overvalued than it was in 2000. In terms of market concentration, that's higher than it was in 1929. I mean, I think, especially when you're starting to see a lot of long-term bulls throw in the towel, it's not so much a recognition of the fact that markets can stay bubbly longer than the investor can stay solvent. I completely understand that, but you're in a surreal reality. Which is an oxymoron, right? You're in surreality when you run out of precedents, when you run out of means by which to compare where we are. And so much of it right now is predicated on the strength of the U.S. consumer. And rightly so. Don't get me wrong, rightly so. It's just, even when you talk about the strength of the U.S. consumer, then you have to talk about a whole nother set of distributions. And then you're once again having a discussion macroeconomically that's in the tails.
Now I'm going to play a piece from James Conner, going from Vancouver over to Toronto. James Conner interviews Henrik Zeberg, and Henrik Zeberg is from Copenhagen, smart guy, and I think I've generally agreed with him. He is not, none of these people, maybe Daniel DiMartino Booth is a little bit, but when you look at Zelof and Zeberg, I would not say they're perma bears. If that's the market conditions, they will say that. But Zeberg is as neutral, in my opinion, as you're going to get. And so he says the following: we are close to the top. We may not be right at the top now, but it's not far from here. It's within sight. And the fallout from the decline will start to happen, in his opinion, in January of 2025. This is a month away from where we are now, maybe less than a month. And he makes the case for it. So take a listen.
Henrik, thank you for joining us today. How are things in Copenhagen?
They are great. Christmas time is always a great time of year, so all good here.
When we first spoke this year was early January. I can't believe it was almost a year ago, but at that time you were very bullish on the S&P, and your target on the S&P was 6,000. And even in August, when the market got hit and lost 5% in a week, and everybody thought this was the beginning of the end, and you didn't waver, you still remained bullish, and your target at that time, I think you took it up to 6,100 to 6,300 on the S&P. And at that point, you said we would see a blow-off top. And here we are with a few weeks to go in the year. And I want to get your assessment on where you think the markets are and how do you think they're going to shape up for 2025.
Yeah, so we are. I mean, we still have some room to the upside. So we are around 6,100 now. I think there is just a little bit upside still in the S&P. I think we are getting very close on the Dow Jones, and I would like to think that those two could actually top out together. But I think the Nasdaq may push a little further. So again, with everything here, I mean, I don't focus so much on when, but it's more about which level we are talking about, and the 6,100 to 6,300 still stands, even though I could also see a really strong push into 6,400 if that's but that would be within the the margins of errors, I would say. But that's where I stand. So we are getting closer into it. The structure into the that I look at for the S&P 500 is developing a little more upside, but we are getting very, very close. And I would just say that when you ask me about what I think markets are going, how they're going to perform when we get into the next year, well, I think the fallout will start probably begin in January. We may even see a top here in December already for the S&P and for Dow Jones. The Nasdaq, Bitcoin may also push on for a little extra, as I said, but I think the fallouts could already start to happen in January. So and then it's going to be a tough year. It's not going to be straight down, and we will have major bounces as well, but it's going to be a very, very difficult year.
And before we do a deep dive on where you think these specific markets are going, why don't we first just touch on your analysis and how you and your approach? You use a business cycle approach. Just tell us a little bit more about that.
Yeah, so my business cycle is based on three different indicators. There is the leading, the coincident, and the lagging indicators. The leading indicator, and these are all data that we can get from the conference board. You can get it from Fred. It's just data you can get online actually. So it's not something in a magic box, but it's the way you also use these things and how you understand that they are actually the sequence of things. And I think that is where a lot of people are. What inflation is that before you see the economy is developing in a certain way and so on. And this is actually the sequencing of it and the understanding of that, which is extremely important. So what I see is that we have had the leading indicators leading the economy into a slowdown. And I've been waiting for now to see that the coincident indicator, which is the real economy, which is the production level, it's the NFP numbers, non-farm payrolls, and so on, actually starting to show that weakness. And then you have the inflation, the rates, the yields, which is the lagging indicators. For now, we've seen the leading indicators been declining for 24 months or so, and which is the equivalent of what we saw into the financial crisis. And we are actually starting to see that the lagging indicators in my model is starting to show a lot of weakness there, which is a little funny because in that, in the time between there, we should actually have seen the coincident indicators, meaning the non-farm payrolls that we had on Friday, should start to deteriorate, and the labor market. And I actually think that is happening underneath the hood. And if you really look, closely, you will actually see that the non-farm payrolls that we're getting out these days are just, I don't trust them a lot. Let's just put it like that. So I think the economy is in a much worse place than most people actually understand at this point.
Continuing on with Zeberg, he says the markets, and he is not reluctant to say this, the markets are extremely overvalued. He says insanely overvalued. And when you look at historically, for 100 years, you look at any form of method of valuation, and you would say today is extremely overvalued. And the economy is weakening. Job data continues to worsen. So what he's doing as an economist, he's looking below the surface and saying the market may be going up, but the data is not very favorable. And so that's kind of my takeaway, is that at some point the market will catch up to the data, and it will. And a lot of companies, by the way, are in decline right now. You may see the Magnificent Seven and companies tied to them that are moving up, but that's a narrow piece of the market. So when you look at the broader market is not in good shape, and the broader economy is not in good shape. So listen to Zeberg as he expands on this thought.
So a big part of your thesis is deflation, and this is going to impact many asset classes, including the equity markets and Bitcoin, gold, oil, etc. Why don't you take us through this thesis and why you think deflation is going to set in?
So first of all, when we look at what the Fed is doing right now, they are we expect them to cut by 25 basis points at this point, at a time where inflation is not a problem. I mean, the latest few numbers that we have had, and I think we have this week as well, have been very low. And if you compare it to just 1 month before we entered recession in 2001 and 2007, inflation numbers were way higher than that. So the Fed now is scared of what they unleashed, or what they think they unleashed when they came out with the cuts. They thought that they could keep inflation rates at 2.5%. That was what they said. And what happened was that they went to 9.1. So now they got scared and said, "Oh, we calculated this." But what they're doing now is that they're actually doing the opposite. So now they're being way too hawkish at a time where you can see that the economy is coming into a halt. And again, this is where, if you do not look under the hood with the numbers on the coincident indicators, and you look at it like what the Fed is doing, then you will be way late to the party, which the Fed has been all the time. So the deflationary part here is because the slowdown in the economy and the halt that we're going to see the economy come to. I mean, we have to remind ourselves, we only had a 12,000 job numbers in October, and then people said, yeah, it was because of the hurricane and so on. Well, people just have to explain me why we have seen the unemployment rate just keep going up, first of all, and we have 4.2%, and we saw 161,000 new people actually becoming unemployed, extra new people unemployed in November. So what I'm saying is that the economy is coming to, we are right here now where the coyote is running over the cliff, and all of a sudden you will see that there's no ground beneath us. And that is the problem. When the economy comes to that halt, and the whole stock market is so overvalued as it is right now. It's completely, insanely overvalued. You have, the euphoria that I talked about a year ago also is now slowly starting to develop. We have Bitcoin at about 100,000, and people think it can go to 1 million and so on. I mean, these things are the very definition of that bubble that we're in right now, and especially also if you look at the valuation levels for the stock market. So at some point, that will all come to, actually when the economy catches up with the stock market, or the reality comes to the stock market, we'll see, okay, then things will start to decline. And I can just see that with these kinds of valuation levels, there will be a large gap, down. So we're going to see a large decline in the stock markets. And that will also set its trade, you'll see that in the economy as well. I mean, right now, the US consumer and consumers around the world are not doing well. You see that in the delinquency rates that I spoke about, previously also, and you see that we actually do not have an economy that is rather strong here. You see, it's part-time jobs. People are taking up 1, 2, 3 jobs, or 2 extra jobs sometimes to actually just cope. That is not the very definition of a strong economy. So, this, and with the extreme valuation levels we have, it also, just look at in PE levels in historical basis. We are at extremes here. And when that, that's an inflated balloon here. So when that comes, when the air comes out of that, that is a deflationary force. That is not stagflation. That is deflation. That is price pressures on a lot of things. Capacities have been built up over the last few years where that is not being utilized at this moment. Commercial real estate is, in a complete, state of denial at this point also. So you will see that these things here will actually come crushing down, and that will have in price pressure. And that is deflation. That is not stagflation. So as people start to say. So when that starts to happen, we will see the Fed coming out again, blazing and trying to stop this. But first, we'll have to see that top. And right now, everybody seems to expect that this can just go on, and I'll be wrong.
Okay, well, there you have it. Those are the views of those 3 people, who I have said, and to me, are very credible. So if you have questions or comments, if you agree or disagree, go ahead and put them in the comments section below. Thank you.